we had the market trade back up into a fair value gap, into a bearish order block right here. We had a sell side liquidity pool here with the short-term low, and the market created this fair value gap, traded up into it, and traded softer, consolidated in at midnight last night, New York time. We had a little bit of a Judas swing here, and then we broke down. So we had initial displacement here, fair value gap. The market trades back up into, at the beginning of London open kill zone. That's 2 a.m. New York local time. So think about what I'm showing you here. Time, London open, starts right at the beginning. It's trading at a bearish order block after it completely balances in this sell side delivery. Okay, so in other words, this one single down candle gets rebalanced with up movement. Okay, think about that paint roller analogy. Every down move in the marketplace has to be balanced with an up move. That's efficient market delivery. Okay, so if the market trades back to this bearish order block here at 2 a.m. and it fills an imbalance, it's created an optimal trade entry, another level of displacement, and we have a mitigation block, which is this last down close candle. Why is that a mitigation block? Because we have a high, a low, a lower high, not high, low, higher high breaker. Notice it doesn't get up to that breaker level. Many times you're going to see mitigations form right on the other side of a breaker or a potential breaker. Then this becomes the more specific or sensitive level for institutional trading. So we have the mitigation block here. It trades up into it. Now this also is a optimal trade entry for selling short, targeting the sell side liquidity. Now, is that all that you would be looking for? No. We do 10 pip and as much as a 40 pip grade sweep below old lows or above old highs. Now, remember the 15-minute time frame fair value gap on cable, or the pair British pound versus US dollar. That's this area here, the fair value gap. Now, if it's going to reach down into that imbalance, you have to couple that with other things algorithmically. So what I've outlined here is what IPDA, Interbank Price Delivery Algorithm, was looking to do in here, and I'll cover all these points one at a time. So as a sample of algorithmic theory, the short-term premise or narrative was US dollar short-term bullish, pound dollar short-term bearish, bearish protraction to discount fair value gap. In other words, we're looking for it to trade down here. So IPDA will want to trade to this level. Proximal sell side liquidity pool, 20 pip grade. That means near term sell side liquidity pool, while it's up in here, near term is here. So the closest liquidity pool for sell side is here. And 20 pips down converges with the fair value gap that I've already outlined and pointed to last night. London open trades to a bearish order block here and fair value gap premium array. That's right here at the beginning of London open kill zone. So when you look at these little boxes here, I want you to think about the beginning of it here, think straight down, or if this box is ever underneath price, think of it as the beginning and look up to see where you are in the price action. So at the end of London open kill zone here, then we're not concerned about it until we get to New York. Okay, so we have London open bearish order block here and the top end of the fair value gap, which is a premium array. So we have the premium mitigation array here, and then the institutional order flow entry drill into premium mitigation array, which is here. Remember, we're looking for the single one candles that go one directional, where it begins and ends for that fair value gap, or in this case, it's a SIBI, sell side imbalance, buy side inefficiency. This is a taste of the things I'm teaching charter level. Okay, so that kind of gives you how deep this goes and how specific and how precise and algorithmically price is delivered. Now, I'm not specifically talking about these levels because they haven't formed yet, but we're looking for this level to be traded to. Okay, the grades on runs on stops, okay, or the sell stops that would be below here, it could be 10 pips. Well, what matches that with 10 pips below that? Is it the fair value gap? No. So you got to go down 20 pips. So it's a deep dive of 20 pips. It converges with the fair value gap. So right away, you have multiple things here lining up with price wanting to get down to this area here. When you have this institutional order flow entry drill, which is another optimal trade entry, you anticipate another run down that takes us into the fair value gap. Now, once we do this, we have offset distribution under proximal lows. Now, proximal lows are from this low to high, and the setup that sells off in London. Where are the proximal lows? Okay, or near-term lows. This low, then this low forms as it retraces, and then when the market trades down, what are we doing? We're looking for reasons to take partial profits. Now, you could take partial profits here because the fair value cap could have not really been traded to. It could have avoided going down that low. And if you didn't take partials below this low over here, you could have potentially sat through a reversal and never taken profit. In other words, if you're looking for your absolute objective, which is what I outlined here as a possible sell side target, the fair value gap on the 15-minute time frame, this would have been a failure to reach that objective if you didn't take partials. But it sets up another sell in London and institutional order flow entry drill, which is just trading to this high or just above it. You can go short there. Then it sells off, trades below this short-term low. You want to take profits in here, and look what it does. It goes right down to the bottom end of that fair value gap, and look at the bounce. Pow! Right up into bearish order block, and one more dive below a short-term low, and this is, again, offset distribution. Offset distribution is you're offsetting your short position by distributing some of the position, if not all. So you're always taking profits below a short-term low in your short positions. Now, you don't have to do it at every single short-term low, and as you see here, there has to be some narrative as to why you would be looking to do it anyway. So we have the fair value gap that I outlined yesterday. We have 20 pips below this short-term low, and we're in London, and we've already had 1, 2, and now one more time, 3 times we pressed down, and we went below the fair value gap to the tune of 20 pips. So it's exactly 20 pips, not exactly from low to low, but it's close enough, and that's how we work with and calibrate the levels. Once we have offset distribution under 1, 2, now 3 times we press lower, and we're ending, see what's happening here? We're ending London open. So we're anticipating the market going in consolidation. If it is likely to go lower, we'll look for a New York setup to do so. But I also gave you something yesterday in the discussion, which was day of the week specific. When we are bearish, we anticipate Thursday capping the week around New York open. When we're bullish, we expect the week to be capped in New York open. Now, it can move a little bit more into Friday, but generally, if you use this rule of thumb, it will serve you exceedingly well. Thursdays is kind of like the last day for me. I like to take partials. I like to take all of my trade off if I can, unless there's something really sweet that it hasn't been reached to on Friday. I'll hold some piece of it on. So we have day of the week phenomenon, which is Thursday, which is a range limiter. And all that means is that the weekly range is many times limited by New York open on Thursday, only when it's directional. We traded into now the New York open, which we're setting up the likelihood of a market reversal profile in New York open. So I have a little bit more price action in here. This shows part of the New York open setup. Okay, so everything that I've outlined over here going into London, we have that 3 drives lower here below this sell side liquidity pool. The market runs higher above this short-term high right here. So we have a shift in market structure here, and the market drops back down. Look where it starts. At the beginning of the New York open, 7 a.m. New York time, it creates this low here. And then we start consolidating ahead of what economic driver? U.S. unemployment claims. It was released at 8:30 a.m. New York time today or Thursday. If we look at this low to this high, isn't this an optimal trade entry? So New York session on Thursday, when we have been bearish and we hit an objective down here, what's it likely to do? Well, it's likely to reverse, and we might get this pop. So if you look at what's shown here, so we have a little bit more of a broader view of what's going on, and we have this short-term high over here. So we have buy side liquidity resting above that, buy stops in other words. So everyone that's been trading short, their protected buy stop here on a fund level would be up here. They don't like to trail their stop loss real tight. And we have that shift in market structure here. Optimal trade entry, U.S. unemployment claims report comes out right there at 8:30. And then we have the displacement higher, consolidation above here, and runs through the breaker. This is at daily breaker level. It runs through the buy side liquidity during London close. And in this level right here, okay, it's going to be the fib level. So we have the low to high. Here's your optimal trade entry in here. And what targets can you look for? Well, right away we start with the natural levels, which is the breaker, the old high, where there's buy side liquidity. And is there any fib converging with that? Well, we have a level here, but before the breaker, so that's not good. We have a level here that's above the breaker. That's pretty good. Then we have this old high, and nothing really lines up with that. So the next fib level is here. So as it consolidates, once it gets to this point here, I personally would not be in the market. If you felt like you wanted to hold a small piece on, you can look for that 1.5 extension on the standard deviation of the range down here. So this level here projected out in time, and look at the bodies respecting that here. So it's just a really nice delivery on the upside. Certainly way more than I was anticipating. I felt that we could probably get up to the breaker, maybe fall short just by running above these relative equal highs and filling in this area here, but it just really pushed up higher. And again, go back in here, what I said, we're going to go down to this fair value gap. I felt that it could have went lower, but if it gets down to this level, we're going to get a pop. Now, in full disclosure, I was only thinking we would probably get up to this area here in this gap because it hadn't been up there yet. We went to this point here, didn't get to it here, in no time until here did it get back up into this area. So that would have been a reasonable level for me. If I would have been long going in here, that would have been enough for me. Like I would have been content with that and then moved to the sidelines. But it's January, so I don't trade. And I've been making this very clear to everyone that's just started and everyone else that's been here for a while. You just know. And finally, moving back out to a 15-minute time frame, this run here is on the heels of the low to high down to a discount. And that fair value gap right there that I talked about last night. Okay, so my question to you is, had you not heard me talk about this particular level right in here, okay, that PD array, if I wouldn't have called that out to you and draw your attention to it, would you have expected this type of move today?